Welcome, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, the most important hour of radio every Monday on 1580 The Big Talker. Thank you for joining me this afternoon. For those of you who don't know, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets. Within every market, there are solutions, as well as tremendous opportunities. You just need some trusted advice. That's my message, and I will be delivering it to you every Monday from 2 to 3 p.m. right here on 1580 The Big Talker. And I want to remind you that if you ever have any questions, concerns, real estate, credit-related, financially related, feel free to reach out to us on our off-air line. It's 877-245-2030. That's 877-245-2030. We've got some great stuff lined up for you today. We have going to go over a couple articles. Affordable rental homes are becoming increasingly harder to find. So a lot of questions from consumers and you out there that are looking to find out what the best option is as far as housing is concerned, whether you're going to rent or look to buy. We've got to go over the Fed meeting from last week. We want to let you know what was the statement from the Fed and how is that going to affect interest rates concerning your could-be mortgage and what it means long-term. Also, we've had a lot of crazy weather in the Midwest, and Osama Bin Laden has finally been killed. We found out yesterday, which, is a big thing for us here in the United States. I know, it's something to really be, happy about and take all the politics out of it. It's been literally 10 years since 9/11, but finally, in the end, we have something to at least, and I don't want to say necessarily celebrate, but our troops have done such a phenomenal job for such a long time that I think this is, a great thing. Joining me on our panel today first is Louis Cammarosano, who's the general manager of HomeGain. He's an industry leader, and he's a regular contributor on the Real Estate Radio Network. And coming up later on the show is Pat Hyben with Keller Williams Realty, who is a real estate agent extraordinaire. He sold over $1 billion worth of real estate volume. He was ranked by RE/MAX as the #1 agent in the world in 2006, and he was also honored the same recognition by Keller Williams Realty in 2006. Actually, pardon my French, it was 2004 for RE/MAX and 2006 for Keller Williams. Louis, are you there?
I'm here. How are you today, Ryan?
I'm doing well. How about yourself, Louis?
Excellent, thanks.
Yeah, so, I know that the markets are kind of trying to digest, obviously, the Osama Bin Laden thing, and that's going to take probably a day or two before everything settles back down. I know everybody's, just kind of, at least we have some sort of, I don't know, what do you want to say, solace in that the fact that he's finally been captured and this can be put to rest, and a lot of the sad memories from September 11th, it can at least be, we can get some sort of, I don't know what you want to call it, but, rest with this. I think that it's interesting to note that as far as mortgage rates are concerned for this week, it's going to be kind of a tumultuous up and down week just because when there's a lot going on as far as in the Middle East or anywhere in the world, money tends to go to the safe havens of bonds. So I would kind of suggest that if you are in the market trying to figure out whether you're going to lock or float this week, it could be up and down. So it might be probably smart to go ahead and lock in your rate today. Another reminder before we get started that if you have any questions regarding any real estate or credit-related topics that we cover today, just call the off-air line. That's 877-245-2030. That's 877-245-2030, and I will personally advise you. Now we're going to jump into this week's Word on Wealth, where this is a segment that we give you an overview of what happened in the market last week and anything that affects you, the consumer, financially. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to homegain.com today and see what I'm talking about. All you have to do is type in your home address, and you will get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free, so I highly suggest you guys check that out when you get a chance. It's homegain.com. So we had some better things happening last week, especially in real estate. Let's do a quick review of what happened. On Monday, the market got crushed, and the big story was Actually, let me pull this back up. Monday was actually the new home sales, which were up 11% in March. This is a positive sign for the housing market. Combine this with the record low mortgage rates, it could be, I don't know, Louis, do you think the housing could be making a little bit of a turn around the corner? Or are you just...
But I don't think it's a major turn.
It's just, I think everything is really related to interest rates at this point. Because it seems like every time we get a slight drop in interest rates, have you noticed that the home sales have obviously picked up a little bit more?
That makes sense. But, I mean, the interest rates aren't going to continue to drop. So
No.
that's going to provide the impetus for a housing recovery.
Yeah, and I think it's more, we've been saying that it only takes kind of one thing to make the rates just jump up right out of the clear blue, but it seems like we've just been having, these natural catastrophes throughout the country and things like that that actually have pushed money into the safe havens of bonds, and I think that's all that's going on there.
What might make housing recover is somehow a more widespread belief that rates are headed higher soon.
Yes. And I do know that, a lot of questions from actually listeners on this show have been, interest rate related. People that are currently renting or people that have a timeline to buy, but they're really not, necessarily ready right this second, but they might be in the next 6 months or so. Always asking the question, well, what do you think interest rates are going to do? And I mean, that's $1 million question. You know what I mean? It's nobody can give you a clear-cut answer. I always tell you have to look at based upon today, in your situation today, what would you do? Don't worry about tomorrow, because actually, and I'll get into this in just a little bit about people trying to lock in rates and time the market. It's almost impossible to do that.
Sure, you're speculating at that point.
Exactly, and 9 times out of 10, you're going to cause yourself, if you wait. The average, let me pull this up. It was actually from the mortgage reports. It gave you an actual estimate of how many times rates are changing. And in April of 2011, lenders issued 1.7 rate sheets per day. That means that mortgage rates were changing every 4 hours and 42 minutes on average. So, that's pretty incredible when you think about it, because let's say, Lewis, you picked up the phone, you called me and you said, Ryan, what can I get on a 30-year fixed? And I quote you something at, let's call it today at 2 o'clock. And we know that they're changing almost every 4 hours. I mean, literally, I could quote you the rate. You go home, call me back tomorrow, and it's completely something else. But yet I issued you an estimate of what it was, but until you say, hey, let's lock in, Ryan, and I send you the firm lock-in commitment, you're not locked in. And I think a lot of people have this misconception that just because they got something from their lender that says this interest rate is available, it doesn't mean that it's locked in.
Right.
And that's
available when they quote it to you.
Exactly. And it's so critical for people to understand, especially you out there right now that are currently in a transaction. If you have been quoted and given a good faith estimate and it says, let's just say it says 4.75 and it lists all the fees that are involved, typically, it says that estimate is good for up to 10 business days, but that doesn't mean that your rate is locked in. So it is critical that, when you're speaking with the loan professional, that you say, okay, I'm looking to lock in. I want to make sure that I lock in at the very, very best interest rate. And a lot of homeowners think that they can time the market better than the professionals can. I will personally advise anybody against this.
Professionals can't even time the market either.
Right. And you know what? I pay for a professional service called the Rate Alert, which gives me up-to-date information on basically the buying and selling of mortgage-backed securities. So I can basically make an educated guess as to which way rates are going to go, and that's all I can really do. But I tend to follow a 20-day moving average of where rates have been over the last 20 days because they tend to follow along those lines. So you can make educated guesses whether the bond market is overbought or oversold based upon technical indicators. Just an average person out there, what they're going to do is they're going to go to, let's say, bankrate.com or yahoo.com, and they're going to pull up what the average interest rates are. And I actually had a client call me last week, and they're like, well, I'm looking right here on, Bankrate, and it's telling me I can get 4.5%, and there's asterisks all over the place. And I tell people that's there to get you to call. It doesn't specify what the period of time that you can lock in for. So most locks standard are 30 days. So if any transaction over 30 days, your rate can tend to go higher. It also doesn't specify your credit scores. It doesn't specify your loan to value. On conventional loans, this is huge because if you're not putting 25% down or more typically on a loan, then there's going to be all kind of adjusters that could raise your rate up anywhere from 1/4 to 3/8 of a point. I mean, these things are really critical, and I think that when the average person, you out there that's shopping for a loan, you're not really sure of all the intricacies that come into the actual rate market and the buying of selling and securing a loan on Wall Street. It's important that you do reach out. If you're in the middle of a transaction right now or you're looking to buy, in the next couple months, reach out to a loan professional that understands the market and at least has the tools at his expense to, make an educated guess. Lewis, I know, let's say I was dealing with you. I mean, how important is it to you to know that you're being locked in and not just getting an estimate?
That's the most important thing if you're serious. If you're just shopping around, you're getting an indication of of what you might pay, but really, if you're going to be writing that check or signing up for that mortgage, you need to know the exact amount. You need to be locked in.
877-245-2030. We're talking interest rates. And the interesting thing is, too, Lewis, is that, let's say that you're just shopping for a mortgage because you're trying to figure out what your mortgage payment would be if you bought a house.
Mm-hmm.
And I give you a quote of 4.5%. And let's say that your qualifying ratios are kind of right on the border of pushing up towards 50% of your income, which is what most lenders tend to like to lend up to if you have good credit scores. But then all of a sudden, 2 days later, something happens in the market, stock market rises, bond market basically crashes, and now all of a sudden you're closer to 5%.
You're out.
You're out. Or you're now looking for instead of a $250,000 house, you're looking at a $225,000 house. So, it is critical that you are constantly in touch with that mortgage professional to make sure that, even in the midst of looking, because sometimes, buying a home, that process could be, anywhere from a couple weeks to a couple months to a year.
Right. You know what else someone can get involved in with that is, unfortunately, the interest rates move very quickly. The home prices don't.
Yep.
You can get caught hoping as interest rates rise, home prices will drop. But you could be watching that for a while.
Absolutely. I mean, I mean, there's so many cases I can cite, but short sale examples. I mean, we've discussed this numerous times. I mean, when you're looking to buy a short sale and you get that contract in, the seller signs it, the buyer signs it, but you still have to have bank approval. And I've had clients that said, I really want to lock in. And I say, okay, well, probably the furthest time we can lock out without costing you additional upfront fees is 90 days. So we'll lock somebody in for 90 days. The bank will then come back and they'll take 120, 150 days. Their lock expires after 90 days. And the only way to keep that rate is to extend it. Well, extending it costs more fees. So in the end, there's so many things that come into play. You need to make sure that you have basically a good plan set up to where you're either going to float the market, and if it does look like it's going to get really bad, then go ahead and you can lock in a long extension of like 120, 180 days. You're going to have to pay probably a point up front to do that. But, you need to have a game plan, especially on these short sale transactions. I've seen so many people burnt. I mean, I'm talking the difference of between 4% and 5%. That's a lot of money.
Sure, it's 20% difference.
Yeah, that's huge. And it was, and I told them, I said, look, I know you're trying to hedge against it. What actually happened on this transaction, it went on for about 9 months, and you only get so many extension fees before the lock completely just runs out. So we had put it for 90, extended it for 30, extended it for another 30, and then it completely ran out. So they were then off the current day lock. So, that's just the worst case scenario. Is the best thing is to make sure that, you have somebody that you trust that's making a decision for you. On Tuesday, the consumer confidence was up. The Dow basically busted up over 100 points higher. The bonds continued their upward movement, causing mortgage rates to dip just back even further. On Wednesday was the big day that we had been talking about, Lewis, where the Fed had their meeting, discussed what their policy was going to be moving forward, which is much of the same. The interesting thing to take away from that was they did hold a press conference after the fact where they answered a bunch of questions. I don't know. I just didn't seem to pull too much from that is really newsworthy. They released basically in a statement that they're going to keep their interest rates near 0% where they've been. They said they're going to finish their $600 billion bond buying program is scheduled in June. And who was it? Anthony Chan, I think he was the chief economist at J.P. Morgan Chase, had cited that the Fed gave him no impression that they're at all worried about inflation, so they don't see any reason to be worried about it either.
Yeah, they also, Ryan, what was interesting was not only did they pretend not to see it, they also disclaim all responsibility for it.
Right.
He went on to say that somehow, I was listening very carefully, that what the Fed does cannot impact oil. And as you and I have discussed on this show many times, when you print money and there's a larger amount of dollars chasing the same amount of oil, then the price is going to rise. But he actually went further to say somehow that as the Fed cannot somehow control oil prices, they can prevent the oil prices from causing other prices to rise. And he didn't give any details on how he's going to do that. I didn't understand that comment at all, that somehow the free money, easy money policies of the Fed is not causing oil to rise, but somehow the better approach that the Fed could use is to prevent the oil prices rising from filtering through the rest of the economy. I don't know how he does that. And then someone also asked him a question about the dollar and whether he was interested in pursuing a sound dollar policy. And he said with a straight face that everything he's doing is providing for a sound economy, and that'll provide for a sound dollar. So it seems as if you're right. There is no change. That the Fed is basically saying they need to keep interest rates low. They need to keep monetizing the debt. And then he also threw out that, well, it's really, the Congress needs to act. They need to get their act in order, which is kind of ridiculous because if he didn't print the money, they couldn't spend it.
Exactly.
So it just seems like as he was speaking, gold and silver were rising and all the commodities rose, and it just doesn't seem like there's any real interest in cutting off the supply of money. Now, that's good news, I suppose, for interest rates because he is signaling for an extended period of time he's going to try to push this spring down further and keep interest rates low.
Yeah, I totally agree. 877-245-2030. We're talking Fed meeting of last week. And, I think it's interesting because I think that ultimately, Louis, they know that the mess on the housing side with the banks and the balance sheets and all that is so it really is. This is a big deal. I think that they know that they can't just let interest rates rise all of a sudden because, that's just going to I think we would go off the deep end real quick if that happened.
Right. They have what's called the Hobson's choice, I think, is where whatever they do, it's not going to be pretty. They can ratchet up interest rates, which might be the best thing for the economy longer term, and start to cut the debt down. But if they do that, whatever recovery we have, it's just absolutely going to come to a standstill.
Yeah, the other note, he had also mentioned that the higher oil prices were largely a result of the growing demand from developing countries. That seemed like
been developing for years.
Right. That seemed like an answer thrown out there to deflect.
Yeah, you can't cause. He couldn't blame a drought on the oil prices, so he had to say there's demand. Now the demand hasn't ratcheted up 60-70% in the last few months.
Yeah, they're this low interest rate environment and the money printing, ultimately that is leading to the devaluing of the dollar, which plays a large part into this whole oil conversation, which nobody really wants to talk about. You know what I mean? You have a lot of these countries that are trying to get away from our dollar by trading goods and services amongst themselves.
Sure.
So there is a lot of stuff that's going on behind the scenes that they're not really talking about either. I do think, as far as real estate's concerned, I think this is very optimistic for interest rates. They could probably. I'm projecting them to stay within that 4.5 to 5.25 range probably through the end of this year. At any point they could probably jump up 30 to 40 basis points, but based upon what the Fed keeps indicating, they don't have any intentions of raising rates anytime soon. I would say probably not even within the next year. Because employment is not really improving, and they keep talking about, they're not really concerned about inflation because they think that in order for to have inflation, there needs to be some sort of increase in wages, right? And that's
not true. You can have prices go up.
I know, but that's their argument a lot of the times. If the wages aren't increasing, then there's not really money for people to spend more money. But however,
and they'll cut back on certain expenditures. As you mentioned, you're not going to stop driving to work and you're not going to stop eating. Exactly,
which are the main expenses, food and energy. You got to pay for that regardless. So yeah,
or that they want to strip out, Ryan, and say it's volatile, so you shouldn't count it.
Yeah. And in essence, what that really is going to affect, it is going to affect people that are trying to buy real estate because in order to pay your gas bill and all the other utility bills that are, cost is going to go up on, you may not be able to afford as much of a house as you thought you were able to.
And the other thing it might do is force home buyers to look closer to work.
Yeah, absolutely.
Because the commuting costs from those McMansions gets quite pricey at $4.50 a gallon.
Yeah, I think I was actually driving around trying to find. You're on the West Coast. What was the highest you've seen for regular unleaded?
$4.79.
$4.79. I think the highest I saw was in Centerville for $4.29.
Wow. Now the one I saw at $4.71 is notorious for having the highest prices.
Right. Basically
seeing $4.29, $4.39.
Yeah, but ultimately, these are all things that can, really start to hinder the real estate market even more. When you start having food and energy prices shooting through the roof. That then deters people who were on the fence thinking about potentially buying a house from buying one. Because let's say that they were trying to save up for money for a down payment on that house, and now all of a sudden they're having to use more of their discretionary income towards other things. I know, my wife is a home health nurse, and she's driving around from house to house to house. All of a sudden, if gas goes from $3 to closer to $5, she's almost doubling what she's paying out in gas. It's going to affect us.
Right, and I guess, if you're going to spend money on a house, it becomes one of those perhaps discretionary items, but not if you point out what you've been pointing out, if it's more expensive to rent. So basically your essential costs are food, energy, and throw in housing. If the cost of renting a home is increasing faster than the cost of buying one, then people are going to have to buy.
Yeah.
In those metro areas where that's the case.
Yeah, and that's a good segue there, because I wanted to talk about, there's an article in CNN Money that the affordable rental homes have been hard to find. And we've been talking about this for weeks, that there are a lot of investors out there. I mean, obviously, wealth, it never disappears. It just transfers from one person to another, right? And it doesn't go into thin air. It goes to somebody.
Right.
So the guy that's out there, or the billionaire real estate investors that have all this money, cash on hand, ready to buy these properties, and able to finance them at low mortgage interest rates, have healthy rate of returns. They're swiping up all the would-be foreclosures and short sales they can get their hands on. Well, this is really, we've been talking about this, causing rental prices to rise, and people can't even afford to rent or buy a home, which it's interesting. I mean, it is cheaper to actually buy the home. And let's see, 1 in 4 renters, or about 10.1 million households, spend about half of their paychecks on rent and utilities. That there was a study done. And the number of middle-income renters in this predicament more than doubled to 7.5% during the last decade. And I think it's going to be interesting to see moving forward with the low interest rate environment and the other things that I've talked about, with more people that are becoming more and more credit deficient, as to how this plays out. Because I only see the rents rising even more, because if you have less people that actually can afford to buy the home, and still that low interest rate environments, and you have investors that can afford to put 30, 40, 50% down on that property, I think that this just is going to be a continuing trend. What do you think, Louis?
I can't disagree with that. If you have money, you can make money. If you don't have money and you have inflation, then you're in a tough position.
But I think I want to give hope out there for the person that's, now in a situation where they're trying to determine what they want to do. If you have credit problems, I don't care how bad they are, you need to deal with them now, because it's costing you thousands, if not tens of thousands of dollars more than it needs to. There is no situation that's too bad to start correcting. I mean, I've advised numerous people that had the scores in the 400s and the 500s. It doesn't really matter, because what you need to do is you need to sit down and go over every last item. We can get it taken care of. It might not happen overnight. It might not be next month. It might not be 3 months from now, but we eventually will get it sorted out. If you're able to start, getting your credit reestablished, then you're going to be on a better road than you would be if you didn't.
Especially when there's no bargain to having a good credit score if the interest rates are ahead of the inflation rate. But in these current circumstances, it's kind of an asset if you can get a low interest rate right now and lock it in for 30 years.
Yeah. Really, I mean, we've talked about it, that, you're protecting yourself from future inflation when you buy, a home. So you can, really capitalize on a low interest rate environment. And even, let's say that you only plan on staying in that home, Louis, for a couple years. If you plan on holding it and you can rent it out, I mean, I've seen more and more across this Washington, D.C. metropolitan area where people are actually having a net positive cash flow, even when they decide to move out of the house.
Well, that's an investment then. That's not speculation. But I think, as you know, what happened in the mid-2000s where people were just speculating on price appreciation. They weren't giving any consideration that if they had to rent it out, that they wouldn't be able to pay the mortgage.
But I think more and more that strategy is kind of shifting to more of an investment than in the speculation of housing, other than the people that are buying foreclosures at auctions and trying to flip them and sell them in a month or something like that. But
I think everyone learned a collective lesson that real estate doesn't go straight up and that the laws of economics apply to any asset purchase.
Totally agree. So, if you're in that situation, please reach out to us, 877-245-2030. I'd gladly point you in the right direction. That's 877-245-2030. We're coming up on a break. When we come back, we'll be joined by Pat Hyben with Keller Williams Realty. See you right there.